18.
Brought to you by Hitachi. Inspire the next.
Hello and welcome to this special program coming to you from on location, the World Economic Forum's annual meeting in Davos. Now, one survey pointed out that Indian CEOs were the most optimistic of all CEOs from across the world when it came to corporate growth as well as the global economy. To get a better sense of how India is looking at the world and how the world is looking at India, I have with me Uday Kotak of Kotak Mahindra Bank. He needs no introduction. Mr. Kotak, thank you very much for your time. Let's start with what you're gauging of the global mood here in Davos, given all your conversations with business leaders ever since you arrived. Is it one that is more optimistic or one that is hopeful of stabilization, not a recovery?
I think the world this time around, particularly about Europe, is more comfortable that there is no crisis, especially in the short run. Unlike last year when the biggest debate was, does Europe get into a crisis? So from that point of view, the world is a little more comfortable. At the same time, through 2013, I think the corporate world as well as the financial world is assuming easy liquidity. The issue with this situation is that it is leading to some amount of complacency that the central banks and the politicians will ensure easy liquidity, low interest rates, and though the growth will be slow, in fact in Europe maybe close to zero, no crisis, therefore we will chug along. And the issue which one has to keep in mind is that when you start getting more complacent about markets, you also begin to have a fat tail.
Fair enough. Many people are not expecting this withdrawal of the monetary stimulus, but what are you expecting, given that not very long ago, a few weeks ago, we saw minutes of a Fed meeting that indicated that several of the voting members thought that soon it will be time to start withdrawing from the billions and trillions of dollars that central banks have started pumping into the economy?
I think with Draghi and Bernanke being there and more concerned about recessions and depressions, I would be surprised to see any tightening of liquidity in 2013. 2014 is another matter. We can talk about it then. But as of now, for 2013, looks like easy liquidity.
You struck a stable note for Europe based on your assessment. What about the US? Growth will be maybe 1 or 2%. I think the most positive outlook is 3%. But I think the more important issue is the politics in the US. We went past the fiscal cliff to now be faced with the debt ceiling issues, and that's going to have a substantial impact on the US's fiscal deficit. How do you see this evolving over the next 2-3 months?
US, interestingly, is looking like lower growth in the short run, 1 to 2%, mainly because of issues around politics between the different parties. Medium-term US looks like it has the ability to come back because of shale gas and various other creative stuff which US is doing. So US is a picture of short-term lower growth but getting better in the medium term. In the case of Europe, short-term low to zero growth and medium-term uncertain. That's the difference. You've drawn for us the sort of the broad economic picture. I want to talk to you about corporate growth, right? So what I've been picking up from the people I talk to seems to indicate that there will be growth, not too much of it, but there will be growth, but most of it will come still from sweating existing assets, cost cutting, efficiency, not necessarily expansion, hiring, new businesses, new programs. Given that scenario, do you think that this year will be the year we'll see that $1, $2, $3 trillion that's sitting on corporate balance sheets being put to work globally in terms of investing in new businesses, or do you think that will have to wait till 2014? I think at least in the first half I don't see it happen, but as things develop during the year and if there's more confidence which comes in, you could see some of that, but it will be safe to assume that not much of it will happen at least in first half of 2013.
Based on what you've drawn out for me, have the markets overrun themselves globally, not just in India, given that we ended 2012 on multiple year highs on the S&P and the Dow, and that sort of bullish phase continues into the new year, yet everything we hear about the fundamentals of the underlying economy is not glamorous at all?
I think the policymakers in the world have taken a framework which is give markets the steroid so that the economy holds.
Okay.
And in some way, this has worked because we have avoided a crisis, whether it is the US, whether it is Europe. And both Bernanke and Draghi ensured that the markets continued to hold up, the financial markets. And while the economy did not run away, it at least held up and we did not see a crisis.
But as we stand today, do you think that we're looking into the face of a substantial correction in global markets, given that this year is really not going to deliver much growth?
I think the real test for the world is going to be the currency wars, because everyone is in the business of competitive depreciation of their currencies, and none of the currencies can keep on depreciating against each other, and you have no new currency from the Mars.
So how do you think it's going to play out? We saw better than expected strength in the euro last year. The dollar continues to play both roles, the weaker role when it comes to the US fiscal deficit, the more stronger role when it comes to the safe haven. With what's going on in Japan, there is forced weakening of the yen. We've seen that in Switzerland as well. How do you see this currency issue play out vis-a-vis, of course, the rupee?
Menaka, the long-term solution is either you cut fiscal deficit or you inflate your way out of it. If I had to be a betting man, I think most politicians would at some point of time prefer inflation over doing the hard stuff.
Okay.
And that is why I feel that the world is going to see significant back-ended inflation as a solution to the huge nominal deficit problem.
All right, but what does that tell us about which currency will win in this currency war that you pointed out?
If you look at it right now, the interesting battle is the euro has begun to appreciate, because as stability comes in, people are saying the euro seems to be undervalued, and that is completely contrary to what you saw in 2000.
And what Europe needs, right?
Correct, but it is helping the US because it's letting the US get a little bit of breathing space. And in many ways today, the two carry currencies in the world have become the US dollar and the Japanese yen.
Yeah. So you expect that to continue through the course of this year?
Yes.
You don't see any big upheavals in the currency market based on what we've seen in 2012?
I would be surprised.
Okay.
So watch out for not only the euro US dollar, but also what happens to Japan. And the Japanese yen in the last few weeks has depreciated nearly 8 to 10% against the US dollar.
Right.
That's a lot.
Okay. I want to move to talking about India. Are you picking up positive signals about India from the people you talk to here? Because I'm not.
I think
Hopeful, yes, but not ready to go, ready to invest as yet.
I think there are two categories of investors right now. One is what you call as strategic, and the second is what you call as portfolio. I think strategic investors are more cautious. The portfolio investors are still ready to put money into the Indian market, especially considering that there's a lot of liquidity and very low interest rates globally. So India is therefore likely to see more portfolio flows rather than FDI.
Okay, since you mentioned interest rates, we have a policy announcement a few days from now. What's your expectation? Is the market priced in a 25 to 50 basis point cut?
I think through the first quarter, whether it's in January and or March, we should see a total of 50 basis points cut.
And is that going to be enough to stimulate growth as CEOs keep asking for it?
Menaka, keep in mind that you just can't cut interest rates too much, keeping the external vulnerability of the country.
Absolutely, yes.
And therefore you have a huge current account deficit.
Yes.
Oil is not going down. We're still at 111, 112.
Yeah.
And that's the biggest item of Indian imports right now.
And I was just talking to the chief economist at the International Energy Agency, and he said that he wasn't expecting crude prices to dip substantially over the course of this year. So I suppose that will continue to be a big problem for us, because in the short term there is no way to fix our energy security needs, right? Last year when we met, we were talking about gold. Remember, you were talking about how urgently the government needs to do something to stem the gold imports coming into the country. Since then, we've seen 2 duty hikes, one come in as recently as a few days ago. I don't want to just talk about gold, but give me the broader view of how you see deficit fixing efforts work out through the course of this year.
I think on oil, I do believe that the diesel price deregulation, if I can use that.
It's so tiny, Mr. Kotak.
Baby steps, if they keep on taking them, that will be good news, and that can help. but we must
Substantially?
not stop the baby steps.
Some 10 or 12,000 crores is what they seem to have estimated.
But in my view, if you do 50 basis points or 50 paisa every fortnight or something like that, I think you get a long way over time. And if we do through this year even 4 or 5 rupees on diesel, half the subsidy is taken care of. But that's what I think the politics of the day will permit the government. But I think it's a positive step. On gold, we have to fight the battle two ways. One is the battle which we are fighting through duties and everything.
Right.
Second is to make Indian financial assets more attractive for Indians.
Right, so
one of the most interesting paradoxes of the last 12 months for me is that India is importing foreign savings into Indian equities and exporting Indian savings into foreign gold.
Right. Yeah.
It's time Indian savings went into Indian equities. And if I would like to see significant policy initiatives, it is in encouraging Indian savers into Indian equities.
Can anything be done in the shorter term? I know there was the Rajiv Gandhi equity link scheme. I'm not sure really how much of a boost it's going to be to bring investors back. In fact, we've seen institutional investors withdraw from the market or sell down over the course of the last several months, even though foreign flows have continued. What is it going to take to bring both domestic institutional investors and retail investors back into Indian equities? And can anything be fixed, let's say, in the short-term way? For instance, the budget that's coming up.
Markets go up on walls of worry. 2012 calendar, Indian equities gave investors 25% returns, and the Indian investor through this entire period remained skeptical. But 25% annual return is certainly pretty good. I would like to see some more boost in terms of reducing post-tax hurdle rates on debt and debt instruments, because there are many tax-free and tax arbitrage instruments out there which increase post-tax returns for savers. So as a result of which a lot of money is in high post-tax returns in debt. The second one I think is make a scheme like Rajiv Gandhi scheme or another scheme far more attractive. The Indian saver who's going to come and put his money into financial assets is not a financial inclusion saver. He's the one who's past buying his first refrigerator, his first television, and has disposable surplus. So that's the target audience for Indian equities, and that's the one who's buying gold. So go after that saver who is more in the mass affluent category and have a scheme which attracts him into that financial asset. That's the way you compete against gold.
Mr. Kotak, we've known all this and yet we haven't been able to do what it takes, despite efforts by SEBI, maybe to some extent by the Finance Ministry, to bring investors back to this market. Is this something that's going to get fixed or resolved over the course of this year or next? Or this is a far longer term program that needs to play out, right?
See, I do believe that our current Finance Minister is sensitive to what's happening in the marketplace, and I have hope and confidence that we will see measures which stimulate Indian equities for Indian savers, and that will be the best competition for gold.
Are you ignoring the fact that this budget is also likely to be a revenue raising budget? And we don't know yet how he's going to do that or what taxes we're going to be faced with, but there's no doubt that we're all going to have to pay higher taxes over the course of the next year or two. In the face of that, do you think any moves to bring investors back to the markets, equity markets, are really going to succeed?
See, the investors play the markets on two criteria. One is micro companies, which may have some pain because of some revenue raising measures by the government. But on the macro, if the macro fiscal deficit situation looks better, that will give a lot of confidence to investors who are playing the macro India theme.
But if personal wallets shrink because of higher individual income taxes, if that at all is a possibility according to you, then doesn't that disincentivize people from saving and investing?
I believe the personal wallets are large enough to be able to accommodate more money into equities.
So are you expecting taxes to go up both on the corporate as well as the personal income side?
My view is marginal. I don't expect anything significant. I think more tax corrections will happen in the indirect side, including in the oil sector. I am a believer that we will see for 2013-14 a budgeted fiscal deficit number projected sub 5%.
Okay. The other part of this problem is getting the investment cycle going. Yes, we've heard some good, or seeing some good positive moves by the government, whether it's FDI and multi-brand retail, or even what they're doing on the front of diesel. Yet there doesn't seem to be enough movement to get the larger projects started in this country. What is your view based on all the companies that do business with your bank? When do we see the investment cycle come back?
Menaka, we have so far talked about markets.
Yeah.
I believe the economy is behind the markets.
Okay.
And
so the
it is lagging the
ahead.
markets.
So markets will run
Certainly.
ahead.
But markets going ahead can help fix the economy. Number one, it's going to give capital to banks who are supporting these companies.
Sure.
And maybe at a second stage give some direct equity to some of these companies, which I think will happen not in the first stage, but maybe later. In terms of the investment cycle, I think we are 12 to 18 months away.
Still.
Yes.
But that doesn't look good at all.
No, but that's the reality. It doesn't. It's not like a button.
But it can't be access to capital, right, Mr. Kotak? Because if we saw the markets rally 25% 2012, there were ample opportunities for companies to come in and do their fundraising. Yet all they seem to be talking about is reduce interest rates, make debt more affordable to
But
us.
that's pretty clear why. Because a lot of these companies have high leverage. The equity values are low. Therefore, markets going up is not dramatically changing their equity values. They need lower cost of debt to first fix their excessive leverage.